What's going on, everybody? It's your boy C-Zar, and we are talking about the Federal Reserve interest rates today and how they pertain to both the stock markets and the cryptocurrency markets. With the impending thought of the interest rates taking a drop in September, there's a lot of people out there who are coming up with their own theories and ideas as to what that could mean for both the stock markets and the crypto markets. I've seen plenty of people in the Discord channels, on my YouTube channel, on other YouTube channels, who like people who make videos saying this stuff, saying that the interest rates dropping would imply that the markets are going to crash, and that every time the interest rates have dropped, we've seen a market crash. There are people in those exact same spaces that say the exact opposite, that every time we've seen an interest rate correction, that we've seen the markets explode. And I want to go over both of those today in this video. I want to show the facts and actually illustrate why neither of those things are 100% accurate. At times they are, but throughout history they're not 100% accurate. If that sounds good to you, hit that like button, subscribe if you want to see more content like this. I'm going to pause the music and I'm going to try to talk without stumbling over my words. So let's get on to this. Right here, this is the I'm sorry, right, my big face is still on here. We're going to get rid of that. Boom. We're going to put the small face on. Hi, here I am. And this is the Federal Reserve interest rates. It's only available on the monthly time frame, right? Because they come out with the rate change, or the rates being stationary, once a month, right? It only changes once a month. So it's a straight line chart. I guess it's not a straight line, but it's a line chart. No candles, nothing like that. And I want to pull up the correlation coefficient with this chart. Okay. This goes all the way back to 1971 actually. SPX, the S&P 500, we're going to correlate it to that. And you can see right here on this correlation coefficient, what this means for those of you who don't know, is, a 1, the 100, the 1 right here, would be a direct correlation. Whenever this reads a 1, that means you're getting a direct correlation. In other words, if this is dropping, the S&P is also dropping. You can see here that as it's dropping, we are gaining correlation, which would imply that as this dropped, the S&P was also dropping. There's points in time where you can see decorrelation happening, and this decorrelation actually happened as we dropped down here as well. Just kind of showing that neither statement is true. That either way, however you want to look at it, that interest rates dropping causes the market to pump. That would be wrong in this instance. Interest rates dropping causes the markets to dump. Well, this is getting inversely correlated. That would be wrong in this instance as well. If that doesn't make sense, if you don't like the way that looks, I feel like this whole indicator, as an example, just shows the validity of what I'm saying, that neither of those statements are 100% true. Because if they were, if interest rates dropping every time meant that the stock market was dropping, you would see a lot more dominant correlation than you would in correlation, and vice versa. If interest rates dropping cause the stock market to pump, you would see an inverse correlation. But you don't get that. It's like 50-50. It's a coin toss. And we'll go over kind of why I think that is in a second as well. But if that doesn't do it for you, let's actually compare the chart itself. If we go to the S&P, this is now the S&P versus the interest rates, like on two line charts, right? So the orange is the S&P, the blue is the Federal Reserve interest rates. And I'm going to try to make this to where it's a little bit more visible, hopefully. Let's see. Bring this down. We'll go all the way back in time. We'll go over several examples, right? Here, you can see that the interest rates are pumping, moving up, and the stock market is actually moving down. Here, the interest rates have topped off, and this was very near the low, but not quite at it. As they dropped initially, the stock market did continue to drop, but really that was pretty close to the low. Interest rates really start to take a dive, and the stock market moves up. First example, interest rates dropping was actually good for the stock market. Interest rates chill out, stock market chills out. Interest rates pump, stock market kind of dumps. But then together, interest rates are moving up and the stock market's moving up. However, you can see at this instance, we saw a nice little sharp decrease in the interest rates, and the stock market did take a 1-month nosedive, but continued to climb afterwards, right? Then when interest rates really started to move down, you saw the stock markets moving down as well. This is an example of the opposite of what we just saw over here, right? Showing a kind of like, who cares, right? It's not one way or another. However, we can see that as the interest rates are gradually moving down over time, the stock market is gradually moving up over time, right? kind of an inverse correlation, more or less, as time goes on. If we look at the stock market on this example, right? Maybe actually here specifically, we get this nice gradual decline. The stock market's moving up. Interest rates are climbing. Stock market actually takes a pause, and it's only once the interest rates stop climbing and even start to move down a little bit gradually that the stock market moves up again, right? Stock market starts to turn its head to the downside as interest rates are pumping. That's whenever it finds its high. But really, it's when the interest rates fall off a cliff that the stock market really starts to take a dive. It just happens one way or another. It's not directly correlated one way or another. And I want to get to kind of the meat of what I believe is going on here, right? It's not just random. It can be. I think it can be. I think we've already established that it can be, especially when you're looking at it through the very thin lens of interest rates dumping means the stock market's going to dump. Interest rates dumping means the stock market's going to pump. If you look at it like that, you're wrong either way, right? You might be right sometimes, and you're going to be wrong sometimes as well. But what you should really look at is the way that the interest rates dump and the way that they pump in reaction to the stock market. Again, this gradual decrease here was not too dramatic for the stock market at all. Kind of flat here, and I suppose when it took its initial drop, you saw the stock market dump for a month, but really over time it started to move up as the interest rates were dropping, and it didn't chill. It didn't see a lull really until the interest rates started to increase, right? But this was a gradual dump. And same thing back here. This was kind of, and it seems kind of intense looking at the chart right here, right? It's kind of intense, but it's more gradual than these examples are over here. And this is when we saw the stock market pump. If we go to these examples over here where they are very intense, much more intense than what we've seen, and if you don't believe me that this is intense, let's just draw a line from the top to the bottom. We don't have to make it like puzzle piece like the way that it looks. I'm just drawing a straight line from the top to the bottom versus a straight line to the top to the bottom here. You can compare these lines and see that they are, in fact, at like different slopes. And it's not the line, I guess this line's better fit than the other line, to be completely fair, but I think it's fair to assume or say that this is more gradual than this drop here. This much more intense drop was correlated to the stock market correcting. This much more intense drop here was correlated to the stock market correcting. Not only do we see the stock market correct with intense drops, but we also see corrections with intense pumps. Right here, from like a 1 month period, we started at a 0.25. Here's your readings up here, 0.25 read. The next month we jumped up to a 0.5 read. The stock market didn't dump by any means, but it did happen to be on this month that it went from being neutral to having a pop up that we saw the stock market dump a little bit. Right? It took a pause. It went down a little bit. But interest rates this time kind of gradually increased, right? And we saw the stock market increase with it. But whenever we saw this huge just dump right off, the stock market corrected right here, and it doesn't look that significant, but let's actually look. Let's take a deeper dive as to what this was, right? It was only 1 month really that the interest rates fell off a cliff, right? Right here. This was the month. It only took 1 month. So from the month of February to the month of March 2020, they dropped off a cliff, right around COVID times. Stock market had already begun to drop 1 month prior to that, and really saw the full fruition, the full, strength of this drop in March. And there's a bunch of other things that were going on as well, right? There was the COVID crash. There was all kinds of things going on in the world. We were having high inflation, stuff like that. But just keeping it specific to the interest rates here, coincidentally, or maybe not so coincidentally, it did happen with a very sharp decline in the interest rates as well. And we did see a quick bounce afterwards. But if you look at it that way, you might think, oh, it was just 2 months that it dropped. That's not a big deal, right? But it kind of is a big deal, because really what it was a drop that we did not recover from, not fully, for, if we saw the end of it, actually we saw the beginning of it here in January 2020, we did not get above that point until July of that same year, 6 months later. This 1 month of federal rates dropping at a very sharp decline, extremely sharp, caused 6 months of a lull for the stock markets. Even more than that, really, because we broke above it 6 months later, but we hung out in these areas. We didn't really get going until, I suppose that'd be like 10 months later, man. Like 9 months, right? a very long time. It took for what was 1 month of a serious move and the rest was neutral. It caused some mayhem. It really didn't allow us to continue some steady growth in the stock markets until at least half a year later, if not longer, right? On the bright side, again, the drop was done just as quickly as it started. That's kind of nice, but we didn't recover so quickly, right? So going forward with this kind of idea, and I think all these examples, here, for example, also, you pumped in a very intense amount of time, and you saw the stock market dump, right? Again, it doesn't really matter if it's moving up or down that causes the stock market to dump. That doesn't seem to be the case, like the truth in the matter. I think it's the intenseness. It doesn't matter if the interest rates are moving up or moving down. It matters how intense it is, whatever direction it chooses. I theorize, we could see the interest rates moving up gradually, and the stock market and the crypto markets could still increase. We might see an initial dump because it's not what people are expecting, or maybe that we'd see a pump because I feel like the large majority of people are expecting a dump if the interest rates drop. But we could also see it moving down as long as it's gradual, and see the markets continue to climb as well. It's these very sharp movements that seem to throw things off, okay? And it does seem, to me at least, right? I mean, it may not even seem, it's very obvious in these charts that these intense drop-offs didn't happen until this moment here in about like 2000, right? We didn't see our first intense drop until 2000. Everything else, this was somewhat gradual, gradual over time, kind of intense yet gradual, right? Not nearly as intense as these cliff drops, right? You can just look at the lines, nothing. This one's kind of close, but still not as intense. Definitely not, right? Intense as hell. This isn't even, and it looks intense actually, but this is actually more gradual. And I think that's why the market reacted in a positive way, more or less. Whereas this one was a lot more intense than this more gradual one. It seemed intense still, but it's not like this, right? That's like a straight line up, and you can see the difference when you draw it this way. There's definitely a difference, right? So it can be somewhat intense and gradual over time, but we just don't want to see these humongous jumps month after month after month, up or down. And I'm not beating around the bush. I'm just kind of hitting this thing over and over again, beating it like a dead horse is what I was trying to say. I think I've delivered the point, but it's not whether it moves up or down that's going to be good or bad for the markets. It's how it moves that's going to be good or bad for the markets. So hopefully, and I don't think this is new information. I don't think the people in charge of the Federal Reserve, in charge of the interest rates, I don't think this is something that they are unaware of. I'm sure if I can figure this out on my little computer charts here while I'm at home eating croissants and cookies, drinking water wherever my water is. Actually, it's under the table over there. You can see it. Maybe you can see it. You can see it in the big screen if you pull it up earlier. Anyways, if I can figure it in my pajamas, wearing my Star Wars t-shirt, these guys in their fancy suits who have been in charge of this for longer than I've been alive, or at least been in charge of this longer than I've probably been involved in charts itself, surely they know the dynamics at play too. So I wouldn't assume that a sharp drop causing negative impacts on the markets. I don't assume that would be an unintentional design. In fact, I would think it'd be a very intentional design, but we don't know what the intention is. Do we want a sharp drop? Do they want to see the markets correct? I don't know. We are at all-time highs. It might be a good time to see a little correction. People are very bullish and might be overextended in their positions, right? It's getting toward the end of the year. People need money for all kinds of things toward the end of the year, right? That's like a time whenever people tend to spend money on themselves, and it's not like the best time for investing. And these guys are aware of that, right? So it could put a lot of people in a fragile position to sell. Or maybe they do want to see the markets continue to grow, and in which case we would see a more gradual decline. It can be somewhat intense, but if we get down, if we're at 5.5 right now, and we're working our way down to this area here at 1, or even all the way down to 2.5, as long as it doesn't happen in the course of like 2 to 3 months, it happens in the course of like a year or two, I think we'll be fine. It just depends on how they drop. And I'm just droning on at this point, guys. I don't really have anything else to say. So I guess the most important thing to watch, the most important thing to consider would be how the interest rates are going to drop. And I would assume that if we're going to have an intense drop, we might see what we've seen with the stock market previously. This is the thing I'm going to end on, right? Stock market here topped off actually a month before the interest rates dropped, right? The market, the insiders probably knew what was going on, that it would drop intensely, and we saw this shot. And COVID was kind of going on here. In January, COVID wasn't as big of a deal. It was really March, February that COVID became a more big deal, right? January, some people thought it was a big deal, some people were blowing it off, but it wasn't really until December that things were even made aware on a world basis, and then January especially. But COVID or not, we topped off. We started moving down a month before interest rates moved down. We saw this kind of pre-move, right? Market here topped off 2 months before we saw our intense move, right? It topped off right there. So again, beforehand, if this month of August, if we are expecting the interest rates to change in September, if we see this month of August be a red month, somewhat significant or not, right? If we get a somewhat like relative top, that could imply that we are about to see a sharp decline in interest rates in the month of September or October, right? And that could give us a kind of idea that we might be in a lull for the coming like half year or so, right? It might not be the best thing, right? However, if we get a green month this month of August, if interest rates are expected to drop or change next month, then that could imply that we're going to see this gradual dump in interest rates, right? And I guess we can maybe go over some more examples of this, right? Pretty intense drop here, gradual at first, but intense nonetheless, like still in a very short amount of time. The market topped off here. It was actually, and you can see here, it's kind of more gradual, so the market continued to increase. But then as it picked up, as it got more intense, that's when the market dumped off. Really, right, this gradual drop happened right before it got like a little bit more intense. I don't know, maybe I'm reaching for straws there, but I feel like the market still topped off earlier than it did whenever it got like really intense over here. Here topped off 1, 2, 3, 4, 5 months beforehand. That could have just been a coincidence, I don't know. And then this is all before those times of those intense pumps. We do kind of have intense moments though. I just want to look, see if we can find more. Come on, man, what's going on here? More similarities. Stock market topped off 1 month before, or I guess 2 months before, actually. Sorry, yeah, 2 months before interest rates topped off. But then it had a quick dump, and that actually caused the pump. So that's kind of a non-related factor to what we're seeing right now. I don't know. I guess the best thing to take away from this would be that it's random. It's kind of random, right? But what helps it not be so random is the intensity of the interest rates dropping or not. So at any rate, guys, this video has gone on way longer than it needed to. I think I got the point across probably in the first 10 minutes. So if you like the video, hit that like button. Subscribe if you want to see more. Interest rates declining is not a bad thing for the markets. Interest rates increasing is not a bad thing for the markets. It just depends on how it happens. That's what matters, right? So hopefully we get a gradual kind of decline instead of an intense decline. All right, bye-bye.